Thanks so much for tuning in to Talking Point. I'm your host, Nilesh Shah. The last 2 or 3 trade setups, we've made this markings via various charts on Bloomberg about how globally the Capex cycle this time around seems to be a lot higher due to and a lot of things, including the advent of the electric vehicle theme, the shortage of semiconductors, which is prompting a number of companies in that space to set up capacities and a lot more. And will that spur or make the post-crisis behavior a lot different this time around than what it was back in the global financial crisis of 2008-9? Well, somebody who looks at all of those cycles very, very closely and has almost an eagle eye on everything is Mr. Nilesh Shah of Kotak AMC. And he joins in right now with his thoughts on that and the market at large as well. Mr. Shah, good having you. Thanks so much for joining in. I hope all is safe.
Thank you, Neeraj, for inviting me over here. By God's grace, everything is well.
Super. Nilesh bhai, before we get to the point of conversation, just one quick word, because there's so much happening on the rates, on the taper, and what will happen in India with regards to inflation and interest rates, etc. Can you summarize all of that in an answer, and then we'll move on to the capex conversation? How do you
Sure.
view all of those pieces? Yeah.
So, globally, central bankers have pumped liquidity, kept interest rates low to support growth. And obviously, at some point of time, that had to reverse. But we believe they will do the reversal in a calibrated and a gradual manner so as not to disrupt the apple cart. If we see liquidities flow creating excess valuation, NFTs, cryptos, and unlisted equity comes way ahead of listed equity. More importantly, in 2013, taper tantrum announcements created more disruption in market than actual withdrawal of taper tantrum. And hence, this time, smart investors will not give as much reaction to taper tantrum as they had given in 2013. In India, RBI has done an excellent job in managing multiple objectives. They have absorbed hundreds of $billion of flows in last 18 months, kept rupee still stable. They have ensured massive borrowing program of the government goes through and still interest rates are stable. They have ensured that excess liquidity built up in the system does not translate into runaway inflation, and inflation is well within control, though it is at the higher corridor. They have also supported growth through easy monetary policy, transmission of credit, and lower interest rates. So overall, I think RBI right now is in a pro-growth stance, and they have been managing these objectives quite well, and they will take appropriate action on inflation. And anyway, over next 4 or 5 months, bearing that spike in onion or potato price, inflation should remain within the RBI's higher end of the comfort zone.
Okay, so I'm guessing that as things stand, you do not expect any great gyrations due to policy actions, at least as things stand. Let's see if they change. In which case, let me move on to the talking point that we wanted to talk to you today. There was this chart which I want viewers you to see before I ask my question to Mr. Shah. And this chart is on a Bloomberg story. It is there on our website, BloombergQuint.com. It shows, these are estimates, of course, of how the forecast, at least, of capex would be for the world at large. And this is, of course, universal global capex. So the estimates are, the forecasts are that it will rise about 13% this year. And for FY 2022, the numbers haven't quite yet been baked in. But the point is, viewers, if you notice this, that much unlike 2009, when there was a sharp drop, the next year, which is 2010, there was hardly an uptick. This time around, could this be different, and could it help the investment cycle? Mr. Shah, you look at both global factors and local factors with aplomb. What's your sense about capex because of various shortages around the world on the supply side? And then, of course, how would India react? Maybe we can start with global and then move on to local, however you deem fit.
So globally, Neeraj, by every government has to provide fiscal stimulus to cover COVID-19 shock. US has announced $1 trillion infrastructure spending, and people who visit US do realize that the John F. Kennedy Airport is not as good as Mumbai International Airport. So there is a need for upgrading their infrastructure over there. The same thing is happening across Europe, where they are providing fiscal stimulus by way of infrastructure spend, and that is creating a new cycle of capex. If we come to India, for last 4 5 years, private sector capex has been on the back foot. The higher capacity utilization was missing, and hence there was limited interest in setting up investments. The load was taken by government, and now we believe a cycle is beginning for industrials and capital expenditure, led by one, government; second, by private sector investments like cement, steel, and sugar; and third, by exports participation, either through your parent or by your direct supply. So overall, I see capex cycle rising in India, now supported by private investments as well, and this will bode well for industrials and engineering stocks.
Hmm. Mr. Shah, how does one typically play such cycles? Because there are idiosyncratic themes in which there are very large announcements, either aided by government moves or otherwise, largely by government moves, and be it ethanol, be it the PLI schemes, otherwise. So, does one play themes which are clearly seeing a government support of some sort, or the China plus one factor? Or do you play the ancillaries which are supplying to all of these sectors, so to say, because there the risk might be lesser of whether a sector specific theme fizzles out or no? How do you think you would see this next 2 3 years?
So Neeraj bhai, in our opinion, you should be able to play stocks across all the gamut. For example, on PLI scheme, we are seeing great opportunities in electricals, electronics, and mobile handsets. The auto component policy has not been announced, but we believe as in when it is announced, it will again be good for auto component companies. Textile policy was announced earlier. It was not welcomed by the industry. Now it has been modified, and I believe finally India will get its place in the textile sectors. So the entire PLI spectrum is available, where you can pick up right company based on the valuation and play that investment cycle. We believe PLI cycle is a 4 5 year cycle plus, rather than short term, and hence one should invest with a medium to long term horizon. The second option is to play via industrials and engineering companies. Majority of these companies over last 5 years were in a very tight cost control, as there were hardly any volumes, utilization was low, and they had no option but to cut costs to survive. Now they have improved their processes, cut costs, and they are fighting fit, and suddenly their order book is expanding. Their order book is expanding in the local as well as global market. Their operating leverage will kick in, and they will be able to generate a very decent profitability growth way above market average. So either you play industrials and engineering, or you play to PLI participation companies. Both are medium to longer term trends, and we think you will find many market outperformers in this spectrum.
Interesting. What's the institutional large institutional appetite, Mr. Shah, for some of the smaller themes in which there have been noticeable government moves? I mean, there is of course this much spoken about ethanol policy, but a lot of people say that with the electric vehicle advent as well, who knows where that will go. So while there was initial euphoria, a bit of doubts keeping in for certain sectors, certain quarters of the market, let me put it that way. Then there is textiles, which hitherto has been sleeping, but the new textile minister has been at the forefront of making changes. But there are very small sectors, drones and the whole drone policy, very small sectors. What does a large institution like you do out there? Do you take some participation because you believe that these are meaningful steps, or would you wait for some critical size for these companies to come up to before you take of thinking larger or meaningful exposures there?
So, Neeraj bhai, in sector like sugar, apart from size and scale, governance was a big issue. There were very handful of sugar companies where you could have invested based on their governance standard, and which is where you have seen institutional participation getting restricted in sugar sector. Now the fundamentals of business have changed. In sugar, earlier profitability will go up and down depending upon sugar prices. Higher sugar prices invariably will result into higher sugarcane production and lower sugar prices in next season. Now with ethanol coming in, there is a base profitability, and on top of sugar prices will create their own volatility. So at least from a industry point of view, from a predictability point of view, sugar industry is moving from cyclical to semi-cyclical. Now we need to invest in right governance companies. And your point is absolutely valid. Some of these themes are very, very small. And within that, apart from size and scale, governance becomes a bigger issue. So we have played some parts in textiles, sugar through our small cap, mid cap fund, where our mandate is to invest in small and mid cap companies. But certainly, when we have to invest across our portfolios, we prefer a large cap company, and this is where we have chose to invest into industrials and engineering stocks where there is reasonably large size available.
Okay. The other question on this whole capex theme, Mr. Shah, is around the beneficiaries or potential beneficiaries or existing beneficiaries of the China plus one strategy. And you were at the forefront talking about India being a pharmacy to the world, and will the world accept that? We'll look at India's role vis-a-vis China's role, which has given the virus, so to say, etc. Now, my question to you is this: uh, there's a fair degree of play out that has happened into some of these themes already, but the believers believe that this is probably just the start, or maybe the first leg is done, and now you will actually see the companies which have moved from small to being medium sized, being moving from medium to the large size because the world is looking eastwards and the China plus one strategy is alive and kicking out here. What are your thoughts on APIs, on other back-end pharma manufacturing or contract research, and on specialty chemicals, where I believe you you you've liked them for a while now? What is your stance now? Because they fall squarely into this whole capex thing, because almost every company is announcing a fresh round of capex.
So, Neeraj bhai, for us, China plus one is a great opportunity to narrow down gap with China. In 1980, both of us were of similar size. Today, they are 5 times bigger than us. They became manufacturer to the world. And while we had our own success stories in becoming pharmacy to the world and back office to the world, we lost out on being manufacturer to the world. And now through PLI scheme, as well as generally the anti-China uh, feelings which the world is expressing thanks to Wuhan virus and also other factors, we are seeing that there is a great opportunity coming for certain sector in China plus one. Chemicals and specialty chemicals was one, where just like the technology sector, Y2K provided an opportunity, and that good entrepreneurs build billion-dollar companies. Same way we are seeing in chemicals. China started vacating that space because of pollution. Our ability to produce niche specialty chemical was never in doubt. And slowly, we became from tier 2 supplier to tier 1 supplier. We have seen multi-year, multi-million dollar contracts being awarded. We have seen a company buying more than $1 billion of chemicals, obviously from different players in India. So what happened in chemicals in the past is now likely to happen in many of the contract manufacturing segment. These companies who are manufacturing on contract electrical appliances, electronics, components, mobile handsets, they can become part of the global supply chain management. In some sense, Neeraj bhai, when Suzuki entered India's automobile sector in the 80s, it changed India's automobile sector forever. From being a marginal producer of automobiles, we became large producer and exporter of automobiles. Today, automobile contributes 7 to 8% of India's GDP and more than one third of India's manufacturing GDP. Uh, we believe what Suzuki did with India's automobile sector, there are many such trends happening in chemicals. Probably in it will happen in API, bulk trucks, textiles, auto components, and electricals, electronics, and mobile handsets. They are already moving in that direction. To just give you a very small example of this China plus one, very recently a company came out with IPO. They are auto component manufacturer, and they were approached by a foreign buyer uh, from US to get bicycle components, and they said, but we make automobile components. And he said, automobile and bicycle are the same, both help people in transporting, so can you supply to us? This kind of inquiry earlier was very, very difficult to get, but now people are actively seeking quality Indian supplier. And if we can capture this opportunity over the next 4 or 5 years, it can really support India in narrowing gap with China.
Wow, that's pretty interesting. Well, then it seems to be an opportune time to launch a multi-cap fund, isn't it, Mr. Shah? I mean, you get to play all of these themes large across large, mid, small. What's the rationale for that launch?
So one, Neeraj bhai, we have been running many products in our portfolio, and as size increases, you tend to become large cap oriented. So there was a need to launch a fund which is one-stop solution for investors. Instead of they dividing money in our emerging equity, a mid-cap fund or a small-cap fund or a blue chip, a large-cap fund, they are saying that why don't you give us a fund where you will divide, in small, mid, and large. So this is a fund launched on 8th of September, closing on 22nd September. This will provide minimum 25% exposure to investors in small, mid, and large at all point of time. And the balance 25% will be allocated based on our proprietary model, whether in large, mid, or small, depending upon where the risk return opportunities are. Essentially, this is one-stop solution to customer, giving exposure to stability of large cap, promise of mid cap, and growth opportunities in small cap.
Got it. Okay. I presume, Mr. Shah, my final question out here. I presume that means that you don't, well, let me not preempt. Let me just ask you, do you reckon that there could be uh, a meaningful corrective move in the mid cap and the small cap end of the market? Because a lot of people talk about froth being there, and at the same time, a lot of people say that there's such a bout of underperformance since 2018 that this is just a mean reversion of sorts. What's your thesis out here?
So, Neeraj bhai, in the stock market, you never say never. In Jan 20, if you had asked me, Nilesh bhai, is stock market likely to correct? My answer would have been no. And by March 20, I would have fallen on my face. So it's impossible to predict how markets will behave. But what we want to reassure investors that the longer term growth story is still intact. Corrections are part and parcel of any market. And today, small and mid caps have given great return from 2020 bottom. But when you look at from 2018 top, it is still a below average return. Within small and mid cap, if you can pick up right stocks, which are showing tremendous growth opportunity because of variety of themes like China plus one stroke Atmanirbhar Bharat, home improvement, the rural sector, there are opportunities over there where a long-term investor will still make money. But everyone has to go through the Agni Pariksha. Neeraj bhai, today, hand on heart, if you see my SIP returns across my equity mutual funds, they are all in double digit. They are dream come true for investors. But it is available only to those investors who went through Agni Pariksha in March 20, where for 3 years my SIP returns were negative. For 5 years, my SIP returns were in bare single digits, way below bank fixed deposits. At that point of time, people who didn't, panic, who stayed invested, today they are enjoying double-digit return. So yes, even at today's price, stock in small mid-cap will deliver return, but invariably it will take Agni Pariksha of you.
Okay, be prepared for the same. That's probably the message. But Mr. Shah, thank you so much for taking the time out and speaking to us today on this whole global capex theme and maybe the Indian capex theme as well, and how to play it. Really appreciate your time.
Thank you.
All right, viewers, and thanks you so much for tuning in to this leg of the Talking Point.